Welcome to the Source of Commercial Real Estate, where we discuss all things non-residential commercial real estate. I am your host, Jonathan Hayek, and today I'm talking with Mike Hardy of Cyrus Capital Management. In today's conversation, we're going to talk about this tricky lending environment that we're in. We will also endeavor to bring some clarity to the often murky world of opportunity zones. Mike, thank you for joining me. I sincerely appreciate it. How are you doing today?
I'm doing excellent, Jonathan. It's a pleasure to be here. Thank you for having me.
Great. So let's get right into it, Mike. Why don't you tell us about your background, how you got started in real estate, and kind of what your work looks like today?
Sure, of course. I'm a serial entrepreneur. I grew up my early memories as a kid were shoveling snow. I figured out that I could earn some dollars from my parents, and then the entire neighborhood would pay me to shovel their driveways growing up in New York and Connecticut. I've worked all my entire life, just realizing that hard work and you can build something and something of substance. So I actually grew up really kind of poor. Lived in a mobile home, early memories. My dad was working on his PhD, so my sisters and I were on one far end, my parents on the other, and so I have memories of watching my dad do well through life, and then have always been fascinated by real estate. So long story short, I decided I wanted to be a physician. Was a pre-med undergraduate, went through all the core courses, realized I had zero desire to be a physician, finished a degree, and decided that picked up a business minor and worked as a financial advisor in the early stages of my career. Somewhere along the way, this world of real estate and mortgage banking came onto my radar. And so it's sort of a roundabout journey, but ended up in mortgage, and then I've been doing a lot of real estate investing over the years. So that's a very short version of about 25 years right there.
Thanks for sharing that. I love hearing people's stories, and I love almost every real estate investor has a long and winding road. So, Mike, I know you have a ton of experience in mortgage lending and commercial lending. So, I'd love to talk to you about the current state of the lending environment. Here, we're talking in March 2023. And we've had some regional banks collapse in the last couple of weeks. And there's a lot of fear out there with uncertainty in the economy, uncertainty in commercial lending. There's some concern for especially in the multifamily world coming up in the next 6 to 18 months. So I'd love to get just kind of your reflection of the current lending environment that we find ourselves in right now.
Sure. So, I mean, lending since Frank Dodd Act, lending has been very tight, is the best way to put it. And you know, it now has become a situation where a lot of people that should be able to get a loan, it's still difficult to, just because of the regulatory environment and the underwriting guidelines. The biggest challenge that we see right now on the lending side is the affordability. I mean, I spent a lot of time looking at the differences between '08 and 2023, both in real estate and on the lending side. And if I'm looking at where values are going to be in the future, I always want to pay close attention to obviously the supply and the demand, but then specifically the credit availability and credit environment, and then affordability. It gives us a real good idea for forecasting into the future. The affordability has been a challenge lately, and it's been getting a lot of headlines. It's actually, caused. I think of it like this: almost as if there's sort of a payment shock, in a sense, psychological payment shock, where when things move really fast, the world has not had time to acclimate to a higher interest rate environment. I mean, you look back historically, and you can see typically mortgage rates run somewhere in the 5 to 6% range, at least on average. And of course, back in the '80s, they got well up into the teens, and then we had some market manipulation, Fed market manipulation, and that caused us to get down into the twos and threes for a while. But the bulk of the millennial generation doesn't understand, and is now coming to understand that what a normal interest rate environment is. And so it takes a while to adjust, and so we've had the sharpest federal funds interest rate hike, as far as trajectory of hike, that the world has ever seen. And we've, of course, seen mortgage rates that follow inflation roll with that. So it's just complicated. There's turmoil, there's affordability challenges. I think there's some amazing opportunities at the same time, which I can unpack, but I would say turmoil is the word that best describes it.
Mike, a lot of people are um, rehashing memories of the great financial crisis in 2008 and 2009. And we're seeing some regional banks fail. They're regional, but these are large banks that are failing. And we're seeing some government intervention, and we're seeing some bailouts from larger banks. And people are thinking, "Oh no, is this 2008 all over again?" Do you have any thoughts on whether we're headed back to 2008 times right now?
Yeah, it's a very different environment than 2008, and I think we'd have to bifurcate that into the banking conversation versus the real estate and lending conversation. Those are all very different, and so are we heading back into another 2008? The answer from a real estate and a lending standpoint is unequivocally no. I'll address the banking side in a minute, but from a real estate side, we have a undersupply of housing in the United States to the tune of about 5 million units. I mean, it's dramatic. It's an undersupply. And if you look back at '08, we had a dramatic oversupply relative to the population. So we have a couple things happening. Number one, if you go back to '08, there's a few things that lined up at the same time. One is a dramatic fall off in new buyers coming into the marketplace because of the X generation. X generation, and I look at birth rates, year over year birth rates, and you can get a really good idea of the demand in the future based on population moving forward in a sense. And people in real estate on the residential side, they typically buy when they're early 30s. 33 years old is the average age, and so what we had was rolling birth rates coming to the marketplace, and then all of a sudden a dramatic fall off of birth rates. The heart of the X generation, like it just dropped, and nobody seems to like be aware or talk about that. And at the same time, we had a massive oversupply of housing, and we had of the folks that were in the marketplace, it was we all know the story: subprime loans, people that shouldn't have been getting loans were getting them, they couldn't qualify. So there's a combination of both product risk and client risk at the exact same time that birth rates fell off a cliff, at the exact same time that there was dramatic oversupply pushed in the marketplace. So four things aligned at once. And if we look at where we are today, here's what's different. You look at the millennial generation and the people that are in their early 30s coming into the marketplace, like the tide rolling in, and it's escalating, and it's going to continue to escalate. It's like, if you have a lemonade stand and there's 100 cars an hour going by, and then all of a sudden there's 150 cars going by, and then there's 200 cars, you're just going to sell more lemonade, right? And so that's what's happening on the demand side, and the supply is not enough to meet the demand, not even close. Okay, so that's very, very different. So, I'll hit pause there, but when I look at real estate, a lot of people have memories of what happened in the past. They saw their parents lose homes and friends, family, and they've seen a similar run up in prices and say, I know this story. When it ran up like this before it crashed, it's got to crash again. And what they're not doing is looking under the surface.
Yeah, great insight there. And I think we're largely talking about kind of the residential world. And you hit on something before that I think ties into this, and where you talked about affordability. And we know there's demand for homes, and there's demand for real estate because we saw it in 2021. And then it pretty much fell off a cliff sometime mid 2022. And that's not because people stopped wanting to buy houses. It was at what price people are wanting to buy houses. So at what price, and at what monthly mortgage price can people afford? And so it'll be really interesting to see where residential home values go, because there's clearly demand, and there are also owners with tons of equity. I think that is something that also gets overlooked when comparing to 2008, because there was a huge foreclosure crisis. But that's really unlikely to happen now because homeowners have tons of equity. We had a huge run up in over a decade, where homeowners did really, really well on their values. And so even if times get tough, even if interest rates rise, or owners lose jobs, they're unlikely to get foreclosed on because they have so much equity. I want to ask you about the commercial world. And there's a lot of talk about, especially in the multifamily world, but commercial loans in general. These loans are different. These are not 30-year conventional loans with fixed rates. A lot of commercial loans are 5, 7, or 10 years. Some people, particularly in the multifamily world, got what is now in hindsight looking like some pretty risky debt over the last few years with bridge debt and having to buy rate caps, and now rate caps are looking like they're going to be expiring, and there's going to be this huge cost to renew rate caps. And so there are some economists talking about there's going to be blood later in 2023 as these rate caps expire and operators are not able to purchase new rate caps, and as operators monthly payments just skyrocket after their interest rates could potentially nearly double. Do you have any thoughts on the commercial lending world coming up in 2023?
Yeah, and that's not an area of expertise of mine. I mean, I know residential inside and out, and so I don't know enough to speak from a position of the level of concern that should exist there. I think that, I do understand that there's going to be a fair amount of resets that will take place, and so how that aligns with the recession and what where folks get caught on that front. I don't know that I could speak with a opinion that would be swaying one way or another. It's something we need to keep an eye on. I do think so. The way I look, I'm very macro with these things, and I look at where people with actually, let me speak to this on the residential side, then I'll tie it into the commercial and the banking side. But when I look at the real estate market right now, 27% of all buyers are cash buyers, and 33% of first-time buyers or 33% are first-time buyers, and they have some affordability issues, and then 40%, the remaining 40%, have sizable down payment and no affordability issues. And so the reason I share that is because like that's one of the things that in my mind, to your point earlier, the amount of equity that exists is pretty substantial. But the banking side brings up another dynamic, okay? And this is something that's obviously fresh for all of us, but folks that have money, where do they put their money? Okay, so anytime there's instability, money moves into the harder assets in a sense. Real estate, commodities. I mean, it just moves to it's a flight to safety that takes place. And so I think one of the things that is still unclear in how this will play out, and the Fed got in a FDIC in a no-win position with Silicon Valley just having to shore up the depositors to be able to prevent every other regional and community bank that had some level of concern over are my deposits safe for those over 250 to that it's like they kind of got stuck in a place where it was a lesser of two evils. I look at that and I think there's so many options right now. First of all, it really should be $1 million rather than 250. But regardless, the smaller banks, it's additional cost of insurance for them, so it's punitive to some of the smaller players. But one of the things that I think I'm intrigued with is watching how why are more folks not working with money market and treasury sweeps? Like, it just doesn't make sense to me that people would keep that much cash when there's so many tools available. So it's sort of like this needless crisis that took place. So we could probably get on a rabbit trail on that. But anyway, as far as your concerns over the commercial lending environment, there will be much more turmoil in commercial than residential. Residential is tight. I mean, we help about 5,000 families a year with purchase or refinance, and it is the highest quality credit that we've seen in, you know, 3 decades, actually more, probably 50 years. So the stability there in equity position, and now when people are trying to wonder where do I put my money, it's going to go into those, flight to safety options, which include real estate.
Great insight there, Mike. I want to transition to another area that you've got expertise in, and that is opportunity zones. And I know there is a ton of opportunity in opportunity zones, but there's a lot to understand. And I know a lot of real estate investors are aware of opportunity zones, but a lot of investors just don't know all the ins and outs. So I'd love to dive into this concept with you. Um, can you give us just let's start with an overview of what is an opportunity zone and what is its purpose?
Absolutely. So, an opportunity zone was created from the 2017 Tax Act, and it was bipartisan. It was set up in order to give investors a tax mitigation strategy with capital gains, specifically designed to attract capital into underserved lower income areas. And so each state was given the latitude to design and identify which areas of the state, I can't remember if it was 20% or 25% of the state would be designated as opportunity zones. And by doing so, the benefit to investors, I mean, I think it's amazing and brilliant in concept because it attracts money that normally wouldn't go that direction. So you end up like revitalizing an area, and you increase and, expand the tax base, and you bring life back to areas that are underserved to some degree. It was set up it actually sunsets in 2006 with the ability after 2006, unless there's an extension, no more money will be allowed to go into opportunity zones and opportunity zone funds. So it was really I think maybe a 10-year, 9 or 10 year, 8 or 10 year window. So the benefit to investors is this, and it's the best thing I've seen in the tax code in 100 years. It is any investor, and it's ideal for somebody that has any capital gains, but specifically a busted 1031 exchange. It's ideal fallback position. So an investor can take capital gains and move them into what's called a qualified opportunity fund, which is what we've set up. Qualified opportunity fund. And by doing so, they defer having to pay any capital gains tax until 2027, April of 2027. So you've got an extra, 4 years of compounding growth. However, far and away the best thing that I've ever seen is that if the funds stay invested for a 10-year window in an opportunity zone fund that invests in opportunity zones, all of the growth that takes place inside of that fund can exit tax-free, very much like a Roth IRA. So I'm doing this personally and seeing other investors that get this shoveling massive amounts of gains into a qualified opportunity fund to be able to then have that compounding take place and exit tax-free. So this is one of those, once a generation or, once every 100-year windows. And again, we've got a couple more years. 2026 it sunsets, but until then, it's a pretty amazing setup.
Great overview. I love that you outlined the benefits there. Let's dive a little deeper. Mike, you said that you have set up a qualified opportunity zone fund. Tell me what an opportunity zone fund is and who can set one up. Do you have to be special? Do you need a license? What is an opportunity zone fund?
No, so a fund is we are a Reg D fund, and it's set up specifically for accredited investors only. Accredited investor is a $1 million net worth individual, excluding primary residence, 200,000 of income as an individual, or 300,000 of income as a couple. So those are the qualifications to be able to invest in a qualified opportunity fund. And something that I think is really interesting is this is something that all of the elites and Wall Street folks, they all do this. It just kind of never really made its way down to Main Street for whatever reason. And I'm, I'll give you the short version of how this developed, but I was co-presenting to a series of professionals, CPAs, financial advisors, real estate professionals, investors on all of the different tax strategies available for real estate investors: 1031 exchange, 721 provision, DSTs. We were talking about charitable remainder trust, and the OZ was the new kid on the block. And so we couldn't find an expert. This is a couple of years ago. And so I said, I'll do the talk on the OZ as an investor, saturated in the tax law for a couple of weeks to prepare for this. And that's kind of how this, aha moment was established. And then I'm thinking, this is too good to be true. Like, what am I missing? Spent, a number of months doing the research and realized that there's some big Wall Street funds that do this for their ultra high net worth clients. Like, it's a common thing. It's just not known in Main Street. And so all that to say, we serve the niche that seems to be kind of like, the everyday guy that's got real estate, that's trying to figure out how to build wealth for his family and create legacy, and below the Wall Street fund. Like, that's kind of where we found a sweet spot in a sense, both from an appetite, a purchase appetite, and then also from who we serve. So anyone can set this up. Like, this is just, it's sort of like you can set up a Roth IRA. You can set up you can roll your pension plan into self-directed 401k. All these things are available. It's just there's complexities to this, right? So you have to know what you're doing. You have to have good tax counsel. I have fund management experience in my background, and so I knew enough to be able to at least sniff out the opportunity and put this together. But that's a little bit about the backstory. It's really one of the best things I've ever seen, and it's sad it's going away in a couple of years, but we'll maximize it until then.
Does the Opportunity Zone end up owning the asset? Is it like that, like an LLC that's going to be the entity that owns the asset?
Right. So the Qualified Opportunity Fund would be the owner of the assets inside of the fund.
Okay.
Yep.
And you said that anyone can set this up. So any investor, because I've seen Opportunity Zones, and I've seen brokers advertising that a certain property is in an Opportunity Zone. So if an individual investor wants to take advantage of this, they could go to a fund like yourself, or an individual investor could potentially set up their own Opportunity Zone fund.
Again, yes, it is something that an individual investor, you kind of have to be a certain size for the economies of scale to make sense, because there's a fair amount of and there's some investment and some time to get a fund up and off the ground. A number of months. It's not inexpensive. There's attorney fees. There's fund documents. There's a lot of things to be able to that need to get addressed up front. So it's what we've seen investors that this is where I think the opportunity is. First of all, anyone can do it. It's just not simple, and it's going to take you 6 months of your life to get it up and off the ground, plus the cost. So you have to decide and work with your tax counsel to see is there value in the effort and the upside from this. So that's just a calculation. Where we see the upside, and this is really the song that we're singing, is there's a lot of people that are needlessly paying capital gains because they don't know this exists. They don't want to do a 1031, or they have a busted 1031. And what do? They say, we missed, and they write a big check to the government, right? 20% disappears like that. And so that is wasted wealth. And if people knew this was available, and here's the beauty of it. This is one thing that I forgot to mention, is that when somebody sells a property, unlike a 1031 where they have to move all of the equity and the debt down line, in this case, they can separate their basis from the gains. So you can take your chips back off the table and then take just the gain portion and move that into the fund for the tax strategy. And so there's a liquidity event that happens at the same time, especially with the equity buildup that we've had. So what I see in our area, I mean, being in Southern California, there's a lot of folks that have done really well in real estate, but they're not selling because they think they're going to have a huge tax bill. And if they knew that they could have this tax strategy and get their liquidity back, invest it wherever. I mean, it's a separate decision than where to invest your basis again. So that's something I wanted to make clear because that's a little known secret as well, is you can bifurcate your basis and your gains, invest just the gains and take your basis back, put it in your pocket or reinvest it elsewhere.
All right. So let's go through a hypothetical example of how an investor could execute this. So I've just sold a property and I've got $1 million gain. So that I've already taken my basis out, just my gain is $1 million. And I really don't want to pay taxes on it. I can't get any seller to agree on a price for a 1031, so I don't think my 1031 is going to work. I think this opportunity zone could be good for me. What do I need to do? Can we go step by step? Do I need a qualified intermediary like a 1031? Do I really need to plan this out? Tell me how it works.
No, great question. So this is something that's kind of interesting because there's a 180-day provision here, which means that similar to a 1031 exchange where your money moves from you sell a property, you have 45 days to identify, you move your money to a third party, to an accommodator, and then the accommodator, of course, is the vehicle to the downleg property. In this case, you can actually sell your property and you put that $1 million in your bank account. You have then 180 days to move that from your possession into a qualified opportunity fund. So 180 days still applies. It just can't stay in your possession for longer. It needs to move to a fund in a 180-day window. And so that's something that there's actually a lot of folks that are even looking backwards if they have a property that's sold. And this doesn't have to be just real estate. This can be securities. This can be crypto. This can be art. Any capital gains will qualify. We're just in the real estate space, so that's where our conversation goes. But any capital gains, especially real estate, just given the market we're in, 180 days your position, it can then move into a fund. So in doing so, there's one form that is, I never remember the name of it, but I think it's 8996. And you're identifying to the IRS that this $1 million is now moved into a qualified opportunity fund, therefore takes it off the table from capital gains tax.
Great. So let's keep going with that example. I like Cyrus Capital Management, and I'm going to invest my $1 million in equity with Cyrus into their OZ fund. What steps does Cyrus have to take now in order to maximize the benefits of maximize the tax benefits? I know the government identified these areas as being either low income or just areas where they wanted more development. So now, as you are the fund manager, the operator, what is it? What is your responsibility now to make sure that me as the investor can get the most amount of gain out of this?
Right. So there's two separate things that happen. One is we're managing then our developments, and those have to be within the opportunity zone. So a certain percentage needs to be in the opportunity zone. We have some latitude outside of that, so we manage appropriately. So one of the niches that we have is I've been in the real estate and mortgage banking space for 20 years, and so have been a investor personally. So I have a lot of off-market opportunities that come my way just from my grassroots local network. A lot of the things that we buy, they'll never hit the MLS. It's something that just needs to sell fast. We're in, our overall strategy is the development of 100 build to rent townhomes that are in different pockets of the OZ. So we've got real strong tailwind with rents that are moving our direction. And then we do a series of various like fix and flip projects as well. There needs to be, in order to meet the OZ parameters, there needs to be a pretty heavy investment related to the existing structure. So there's land value, and then we have to have 100% improvement over existing structural value. So buying, land or partially developed and taking it from there, or distressed situations where there's a lot of work needed. So we have our formula that we go through to see, number one, is it in the OZ? In fact, that's right on our website, Cyrus OZFund.com. Right on the front page, you can go there and just it'll highlight where the OZs are across the United States. And then we have our strategy that's a combination of some of these fix and flip projects with the development. And so that's how we manage funds then for our investors.
The fix and flip strategy is interesting. Is there any requirement on how long you have to hold individual assets, or is it just the fact that your money has to be in the fund for 10 years to get the maximum amount of tax advantage?
Right. So for the investor needs to have their funds in a qualified opportunity fund for 10 years in order to have the exit be tax free. Okay. And by the way, one of the provisions we've set up, I mean, I approach this, I'm an investor myself. So this was designed for me to solve my own pain and my own problem of how can I just be much more strategic with tax. So we've actually set up the ability for an investor to margin up to 20% of their initial contribution, their initial investment, to be able to pay the capital gains tax that's due as an option in 2027. Because keep in mind, money is growing. I don't know why they didn't align it so that it was 10 years, but for whatever reason, the tax is due 2027. Okay, so we've set up the ability, if they don't have outside liquidity, we just wanted this to be an all-inclusive, potentially stand on its own investment strategy. So an investor can loan against their investment 20%, pay the tax, and then now they have the remaining 80% goes to a wash loan. So it's a margin loan with an equal crediting interest rate. So it just takes it off the table from an investment standpoint. Then they have the remaining 80% that continues to compound and exit tax free. If that makes sense. So that's one part of your question. That makes sense, first of all?
Yeah, so I think I
Okay.
followed that. I want to clarify. So we're in 2023 right now, and let's say I invest my $1 million with Cyrus, and in order to get my tax wiped out, I need to keep it in that fund until 2033. However, my 20% tax is still going to be due in 2026.
That's correct. So
And
at
then
the
is
end of
that tax
2026,
refunded in 2033?
no. So that capital gains tax is still due. Okay, it's still due. That does not disappear. It's deferred for 4 years. You'll have compounding growth, but let's just say you have $1 million and it's $200,000 of capital gains. Okay, and now you have $1 million that's compounding for 4 years, and let's just do some sort of simple math here. So if we've been running, we're at 13.5% annualized. It's been our growth rate. One of the reasons is we're really nimble and we see off-market opportunities. So we're able to get some really good returns just because of we're, again, below the big boys and above mom and pop. It's really kind of an inefficient market, and so we do well there. But so for someone to have $1 million, and let's just use easy math and say it's 10%. So now we're adding 100. So we've added $400,000 by the time that the tax is due in 2027. Okay, a little more than that with compounding, but to the portfolio. So at that point, there's either outside liquidity or there's not, right? And so then it becomes a decision for the investor of where are my investments best performing? They may not want to take it off the table here because we have a really solid strategy. But if they do, they just say, okay, now I need $200,000 from my 1.4 million. So now 200,000 of it would go into a fixed account with a fixed equal credit or interest charge. And so now that's off the table. So now they have 1.2 million compounding for the remaining 6 years.
Got it.
So now
Thank
that
you.
said, it's not locked up. It's a 10-year benefit, But we've set up, again, the best we can do without compromising the integrity of our structure, which is every year, if someone needs to funds out for any reason, January is the off ramp. So an investor can say, life happened, I need my funds. Think of it like a 1 year CD. Okay. January, you can take your funds out and with a 90-day notice. So September notice, January out. And then we have an on ramp. We have openings every January and every July. And that allows to serve the whole year because of the 180-day, windows.
Okay. Thank you. I got this is the most clarity I've ever had on an opportunity zone. So thank you, Mike. So
You're
to re
welcome. I'm approaching it. This is an investor's approach. Like I am an investor through and through, and have set this up to serve the needs of investors. And yes, we're managers and we do all that really well, but this is very investor friendly. And so the entire thought process is, how do investors win? And so that's the backdrop to this.
So, an opportunity zone is really designed for investors with a significant capital gain. An opportunity zone fund is designed for investors with a significant capital gain. In my example, my $1 million gain, I can invest it in this fund. My capital gains is still going on the original $1 million gain is still going to be due in 2026. However, any additional gain on top of that is going to be tax free, assuming I keep it in this fund for the minimum 10 years. Do I have that?
Yes, you got it. And I'll just let me walk you through how I think, because again, I'm an investor in my own fund, and it is at a 7.2% growth rate. My million becomes 2 million tax free. At 11.6, rule of 72, at 11.6, it triples 3 million. And then at, 15%, it quadruples. Okay. So my strategy is, I want my money to triple and exit tax free. If we do better than that, fantastic, right? But that's where my mind goes. And that's why I look at this as like the best thing I've seen, in the tax code ever, is because where else can you have compounding growth, exit tax free? Like, that's the beauty of this right now. And so my strategy is not to loan 20%, but again, you don't know what happens. Life might be more complicated in 2027. So to have that option is why we put that in there.
You had mentioned that there's going to be a hard stop in 2026 where the government is not allowing any more capital to go into opportunity zone funds. Did I hear that correctly?
That's correct. It sunsets at the end of 2026.
Is there going to be a hard stop where any current opportunity zone funds have to be dissolved, like 2036, or is the opportunity zone fund just going to continue in perpetuity at this point?
Oh, that's a great question. So the tax benefit at 2036 of compounding being able to exit tax free will no longer be on the table. So let's just say we're at 20. You have great questions, by the way. Let's say we're at 2036. At that point, the way I understand this was explained to me by our tax counsel, is that then becomes like a normal fund without the investor being able to pull that money out tax free. So if the investment is that fits the portfolio and you don't need the cash, let it ride. If you want it out, so we will then have a plan to wind it down, based on, it'll be investor conversations. What does the market look like? But after 2036, then we'll look at, this will be opportunistic all the way through. So again, because we're not a behemoth and we're more nimble and sort of in this little niche, there's either amazing opportunities or there's not. And if there's not, we'll start to wind it down. But I would imagine, and what we would plan on, is a lot of investors will say, I would like to have a fair amount of my tax-free gains taken off the table. So we'll plan accordingly.
Okay. Very helpful. And that is, I mean, 2036 is over 13 years
It,
away. So much can happen between now and then. Our government can do all kinds of crazy things in the next 13 years. So it's probably best to not speculate on what may or may not happen in the next decade plus. Let's go through. Is Cyrus, do you I assume you intend to keep your fund open until 2036 so your investors can receive maximum tax benefits.
correct. Yeah,
Okay.
that is absolutely the plan.
What kind of returns can investors expect through an Opportunity Zone fund? Are they making sacrifices on returns and taking lower returns so that they can receive these tax benefits?
You know, I one of the reasons I set this up was I just in surveying the marketplace, I didn't see a lot of places that were as dedicated to the returns as they were to just the tax strategy. And so my thought was, I know the real estate markets and I know how to generate returns. And so why don't, again, this is going back a number of years. I'm going to set this up because I know that we can do it and do it well. So I do think there are funds that compromise on the returns and sort of play, the once in a generation tax strategy, but I'm not willing to compromise on either. I mean, the purpose of this for any investor is the collective end result of the investment. Plain and simple. Understand, mitigate the risk, maximize the investment, and the tax free and tax advantage portion of that enhances the investment. So I look at each of those individually and don't compromise on either.
I'm trying to think about what could potentially go wrong in this scenario. Um, let's say I know we're coming up on our time here, so we're going to finish up in the next couple minutes. Um, there are requirements that you as the operator have to meet in terms of putting capital into the project. Is there a risk for me as the investor investing in your fund if you don't meet the requirements of the OZ fund? Let's say it's a fix and flip that you buy for $500,000 and you only put $100,000 into it, so you don't meet that 100% capital improvement. What's the danger to me as the investor?
Got it. So yeah, we manage that very very carefully. So as far as the investor, I would think that a disqualifying of the fund could happen, from a IRS standpoint if it's not managed well. I think most funds know where the guardrails are and stay well on this side of it to position for market conditions. So at that point, and that's a good question. I'll have to ask my tax counsel that. I would imagine that maybe if that happened, then yeah, I don't know. I would be speculating to answer that question, but I imagine that mismanaged could be disqualifying event to some degree. But I will ask that because you have me curious on that.
Mike, I want to thank you for your time today. You have definitely shed more light on the Opportunity Zone issue for me today. I definitely have more of an understanding of it now than I have in the past, and I'm sure that's true for our listeners too. If listeners are curious, want to learn more about you and your Opportunity Zone fund, where would you like to send people?
Sure. For the fund, the website is www.cyrusozfund.com. And for me personally, and the various projects I do, MikeHardyBio.com is my email is there if you want to reach out on anything specific. But yeah, I'm happy to answer questions. Again, I'm a regular everyday investor that saw this as a once in a lifetime opportunity and set this up to build my own family wealth and have it's become available. And a lot of folks that are in our circles here are understand it now. But I'm a believer that there's when you have uber amounts of money, you can do everything, but it doesn't always trickle down to the everyday person. And so I saw this and I said, I'm not going to miss this window of opportunity. And it'll be just I mean, it was exhausting to take the year to get it up and off the ground, but it's a pretty solid, 7-figure material difference for my family and generations, just simply by getting it up and off the ground. And if others can ride alongside, then we all win. So I appreciate the conversation. You've had great questions today. You had a couple that I've never had before, so I can see the way your mind works. But thanks for the opportunity to present here.
Perfect. Sincerely appreciate your time, Mike. Listeners, I hope you found value in today's conversation. If so, be sure to hit subscribe wherever you're listening to this or watching this podcast. Reach out to either one of us if you'd like to connect. Listeners, I appreciate you. Until next time, take care. Thanks, Mike.
Okay, take care. Thank you.